And when you embrace being an educator, like I used to do when I was talking to clients, I would tell them, I'm here to teach you how to be a successful investor. I know how to do it. I'm going to teach you how to do it. I'm going to teach you how to act, teach you the questions to ask, teach you how to behave when the market goes up, teach you how to behave when the market goes down. And that's all behavioralism. That's all anticipating the biases that are inherent in everybody's decision. And it's teaching them about their own emotional ties to money and how it affects their decision making.
Welcome to Knowing Me, Knowing You, the podcast for the future of wealth management. Thanks for being here. I'm Marla Sofer. Money is a tool. It empowers people. Let's dive into how technology is personalizing advice, strengthening connections, and creating lasting impact. If you're an advisor looking to differentiate, a fintech leader shaping the next wave, or a client ready to take control of your financial future, you're in the right place. Let's get started. Today, we are joined by Pat Sweeny, a visionary in wealth management who has been ahead of the curve for over 3 decades. Pat is a founding partner of Apella Capital and co-founder of Symmetr Partners, a Wall Street veteran turned independent RIA pioneer. Pat has dedicated his career to reimagining how financial advice is delivered, blending index-based investing, financial planning, and behavioral insights. With deep roots in asset class investing and a passion for client education, he has helped scale his firm from startup to multi-billion-dollar RIA, all while staying true to a client-first philosophy. From early use of Vanguard and DFA funds to pioneering tech-enabled planning tools in the 90s, Pat has always focused on the long game. Today, Apella is exploring a unique M&A strategy, emphasizing shared values, full integration, and the next generation of advisors. We're going to dig deep into his perspective on industry evolution, behavioral finance, and building a firm that knows exactly who it is and who it's for. Pat, welcome to the Knowing Me, Knowing You podcast.
Thank you, Marla. It's a pleasure to be here.
I am so glad you're here, and I am so hopeful that you're not hearing my dog barking excessively in the background.
I don't hear much anymore. Yeah,
okay, good. Because my dog just decided to have a little bit of a barking attack. It is trash day here in the Sofer neighborhood. Thank you anyway for being here. And we always start with a question, which is what excites you about the moment that we're in with respect to the future of wealth?
Boy, I said this recently, and it resonated with the folks around me who were younger employees that I was talking to, that I was addressing. I said recently that I feel, based on my experience, this is a golden age for financial advice. And what I mean by that is for several decades, I could go back to the 1930s or 40s, right up through the 1980s, it was a stagnant industry in terms of innovation. It was delivering transactional advice, getting paid and moving on to the next prospect. And now it is so focused on the client experience. It's so focused on delivering outstanding client service, even customer service. Let's expand it from our industry to all industries. And that's a great thing for investors. So I think that's what's really exciting. It's the end of my career, but the financial advisor is probably one of the most important relationships folks have these days after their physician. It's advice that you're going to give to folks that will have a huge impact on the rest of their lives, as opposed to just selling them a product. And that's a good thing for us and a good thing for clients.
Yeah, I love that you shared that. And I also remember when I first joined Wall Street, service kind of had a bad name to it. There was those that had the fancier suits and the better pay. And they were the people that were kind of selling the products all the time. And service was very much an afterthought. You also made that leap from Wall Street to independent advisor. You started your RIA back in the 90s. Can you tell us a little bit about what drove the shift and what was kind of the meaning that really dug into your own purpose and your own vision for why finance should get closer to the human that needs it?
So for me, I was at a major wirehouse. I spent 10 years in trading and sales, and the other end of the phone was an institutional investor, someone who knew as much about investing as I did, and probably more, quite frankly. And so when I made the jump to retail to speak with individual investors, it was with a major wirehouse, a national wirehouse. And it had a great reputation. It was a good firm, but it was all about manufacturing product and moving it through the sales force in a very efficient manner. And it immediately didn't sit well with me because I had been speaking to sophisticated, educated investors on the institutional side. And now I'm speaking to people, many times they didn't know the difference between a stock and a bond. They didn't know what a mutual fund was. And that hasn't changed a whole heck of a lot. So it became apparent to me very quickly that I was being expected to sell a product and move on to the next person and do it as quickly and efficiently as I could. And I wasn't spending any real quality time with clients. It just didn't sit well with me. And this is not something that I had to gaze deeply into and ponder. I didn't feel good about it right away. So I spent almost 3 years at the wirehouse, and they left me alone because I had a background in the business. Many of my clients were in the industry, so they were sophisticated. I quickly came to the conclusion if I was going to stay in this industry, speaking to retail individual investors, I would have to do it in a different way than my employer was asking me to do it. So myself and a friend of mine at the firm, he was 4 years younger than me, new in the industry, and he was watching me and listening to me talk to clients, and he's saying, you're not doing anything that's in the company playbook, are you? I said, no, it doesn't sit well with me. And together we talked about it, and we decided we could do better. And we decided to leave it in 1990, end of 1993. We left and formed our own RIA.
So much of what you just said resonates so strongly with me. And I definitely feel kind of my own experience echoed, and very much part of the reason why I launched Nomi was there was something in the industry that just wasn't sitting well. And it was this approach to, we are going to, as you say, manufacture products. We are going to kind of push it at people. And you recognize that that's not necessarily how clients operate. And so I love that you took that approach. One of the things that I'm sure you hear a lot is you made a lot of really good bets before they became popular. You started using index funds. You were using DFA and Vanguard before that became much more mainstream. And you implemented tech tools to evolve to a very planning-centric approach before a lot of others did. If you don't mind, kind of use that same thread that you started on. It didn't sit well. You wanted to really do something different. You wanted to embrace the client and the client's interests. How do you relate that to those decisions to look at, there's better tools out there. How come we're not using these tools that align with the interests of our clients more neatly?
Yeah, it's easy for me to give you that answer. I didn't have an aha moment, to use the phrase, but it did happen over a span of a couple of years. I was fortunate as a youngster to be exposed to some very high profile, successful investment managers, money managers. And when I say that, it wasn't because their track records were phenomenal. It was because they had a lot of money under management. And when I looked at their track records, they were somewhere in line with a major index, maybe slightly better for a period of time. So what I learned is if you beat your benchmark, first question is it an appropriate benchmark? But that's another issue. Mm-hmm. If you beat your benchmark for a period of time, you can really parlay that into a lot of assets under management and quite a reputation. So I learned early on that professional money managers and professional traders, they lost money with the rest of us when they made a bad decision, and they didn't make money for their clients as often as I had expected. I thought that these world-class managers would be trouncing the market. And in the 80s, I learned, well, they're not. And then I read, which was an eye-opener, an essay by Jack Bogle from Vanguard. It might have been an excerpt from his Bogle on mutual funds, which didn't come out to the 90s, or maybe it was just an essay. But he just cited how well the indexes did versus professional money managers. So to answer your question, when I started the firm, I knew that, picking managers was difficult to beat any market index or benchmark. So why don't we own the benchmark, number one, because the benchmark actually outperforms most managers. And then number two, what can we do to add value to our clients' lives that they would appreciate that they're probably not being offered right now? And in the 90s, at the firm I was at, I'm assuming that other national wirehouses had the same rules. They did not encourage you to get the CFP. As a matter of fact, it was frowned upon. They would not buy financial planning software for you. So they just wanted you to transact. So I knew no one was doing financial planning except for a handful of practitioners, early CFPs. Many of them were focused on tax shelters and things of that nature in the 80s and early 90s. So we did some research, and at that time, really the only provider we could find was Navaplan, that had a robust financial planning product. It would produce a financial plan the size of a phone book. It was kind of intimidating, but nevertheless, it was a differentiator. So You get asked by financial advisors all the time, what's your differentiator? Back then, it was offering financial planning. Not a lot of folks were doing it, and those that weren't doing it well. And so that's what led us to believe we have to offer more than just choosing investment managers or mutual funds. And to this day, I think that's the standard of a high quality wealth management firm. How in depth do you go with your financial planning?
I remember an old conversation I had. So my dad, I like to say, I'm sure he doesn't appreciate it. He's in his 10th year of his 5-year retirement from Merrill. And I remember he said once that, CFPs are just a lot easier than the CFAs. And I don't know if that's how the wirehouses spoke about it to the advisors is, yeah, you can get a CFE. It's easier and quicker, but you should really think about the CFA. And now we're in this interesting era where portfolio allocation is commoditized. And I think that's what you're hitting up on is like you're hitting into the trend that financial planning is the opportunity to deliver value. That is your chance to shine and to get to know your client and to do something differentiated and special and personalized and unique for that client.
Yeah, there's no magic bullet. In-depth financial planning and outstanding client service is going to be your differentiator. Other than that, a software program, being able to pick the next great manager, it's not going to work for you if you're trying to stand out from the crowd.
Yeah. And I want to now kind of talk a little bit about, and here's the proof in the pudding. You have scaled Appella from $1 billion to $6 billion in just a couple of years.
We're closer to $8 billion now.
Oh my goodness. So I got my stats wrong. So
they were right the last time we spoke. We're growing rapidly. We really are. We've signed a few LOIs that will put us over $8 billion by end of summer.
Oh, wow. So listeners to this podcast, listen very carefully right now. So Pat, how? What were the key ingredients? What is behind? I mean, you have done so many things about being in the right place at the right time. You're making the right bets. And what is it that you're now kind of seeing in the pudding that has been created here?
So we could do a whole hour just on that question, Marla. I'll tell you that there are two types of growth, organic growth and inorganic growth, or M&A. First and foremost, we focus on organic growth, most importantly, because M&A comes and goes, is cyclical in nature. Like we just saw for a period of time when tariffs were announced that M&A just shut down in many industries, not ours, fortunately, but many industries. So you can't rely on that. And we're not an aggregator or a roll-up. There are firms that do that. God bless them. That's not what we do. We're a wealth management shop that engages in M&A. So there's a difference. So to answer your question, we focus on organic growth. From what I've read, and you can tell me you've read the same, a lot of firms out there are 1% to 3% organic growth. That's net new assets, no market. And it's almost 100% through referrals. A great gig is having a sole proprietorship, a lifestyle business. The market helps you grow. If you deliver good service, your clients help you grow. You don't have to do a lot of marketing. We've done 10% per year in organic growth of net new assets.
Like the average is really, somewhere in the lower single digits.
Exactly. So that's something that we're very proud of. And we do it, I feel, the right way. So it's authentic to who we are and who our advisors are. We're not a mass marketer. We want to be authentic in every marketplace geographically that we're in, and authentic to our advisors and the services that they offer and excel at, their niche, if you will. So that's number one. And then number two, we've had a great deal of success in M&A because we focus on a specific advisor. We are very particular about who we talk to. And the rule is, number one, they believe what we believe. They believe the markets are more efficient than not. So they're going to be using Vanguard, dimensional funds, or ETFs in a strategic manner rather than a tactical manner. They want to keep costs down. They want to focus on being tax efficient and broadly diversified. So you check those boxes, we're interested. Number two, do you engage in deep financial planning? Is that a very important part of your offering? They check that box. We definitely want to talk to you. And then after that, really in the first meeting I'm involved in. So my team will have 2 to 3 meetings before I'm involved. And by the time I get there, the first thing I want to hear is, if we partner, how will that affect my clients? If they start with that, okay, that's a great sign. The second thing I want to hear is, how does it affect my employees? Check another box. Then we can talk about your comp. We can talk about your time off. We can talk about your office. Great. If they lead with all those other things, those are red flags. I want to know that they're client focused. I want to know that they care about their employees. So that narrows this down considerably on who we actually get serious and talk to. We did 4 deals last year. We'll probably do 8 or 9, maybe 10 this year. And that's contrast to some of these larger aggregators that do 20 to 30 deals a year. And that's a real number. We're very particular about who we talk to. It's got to be a good fit on many levels, and it has to start with the client experience. And if they check those boxes, it's going to be a good talk. It's going to be a good chat.
So you have resisted. I want to talk a little bit about how you're doing that. The environment is so competitive right now. Valuations are extremely high. And you have, as far as our last conversation, you've resisted private equity and you're still growing this aggressively. I have a question about, do you feel that there is a aversion also to the advisors that you're recruiting that also prefer, as you say, like we're a wealth manager, like that is growing other wealth managers, and it is a differentiator again for you in that is your I guess aversion to majority private equity ownership a huge part of the draw, and how are you kind of looking at maintaining that over the long term?
So you keyed in on the right word, majority. We have a minority investor. They don't represent themselves as private equity, but as patient capital. So Wealth Partners Capital is our partner. And two things. Number one, they're not operators. They don't want to run the company. They look for good management teams and they come along for the ride in that respect. And number two, they do bring something to the table. They help us source the candidates to speak to. So the candidates that we're talking to come from generally three places. Vendors that we have long-term relationships with will refer folks into us who are looking to equitize their business or look for succession planning. Number two, our own advisors bring us friends, acquaintances, study group partners. So we've met several there. And then our minority partner, Wealth Partners, is out there looking for what I just described a moment ago, firms that fit this mold. Don't bring us anybody who doesn't fit this mold. And they're very good at doing that and engaging folks. I think it's a unique time in that the RIA movement really started gaining steam in the late 90s. So what does that mean? A lot of folks, probably from their mid-50s to their 70s, demographically speaking, we're starting RIA today. We're starting RIAs back in the 90s, my contemporaries. So it makes sense that there is this consolidation going on in the industry with people who have built a business. They're entrepreneurs by nature, but they've built a business. And suddenly there's interest in helping them equitize that business. And couple that with, well, they care about their clients. They want to take care of their clients, but they have to communicate to their clients what happens to them after they themselves are gone. So the issue they run into is, well, I'll sell it to G2. The practices are just worth far too much money now for the second generation just to buy in. It's very difficult to do. Some folks do it, but it's hard. So along comes private equity and patient capital and permanent capital and family offices to provide money to go out and consolidate. And that's what we've been able to take advantage of. So being in the right place at the right time is definitely part of the equation. And I still believe there are as many RIAs being created as are being merged away. So this should go on for quite some time.
What if financial planning wasn't just about numbers, but about you, your values, your goals, your vision for the future? Nomi is transforming client discovery for wealth managers, going beyond assets and risk scores to uncover what truly matters. With behavioral insights and real-time data, Nomi helps advisors personalize advice, build deeper connections, and grow their businesses. Because the best financial decisions start with knowing you. Discover the future of client engagement at nomi.com. I'm curious to see that. Like, here's my question. Are the RIAs being created just another version of that shifting of seats? Like, they're being created because they're more wirehouse advisors that want to be independent and they're seeing the growth in that channel. They're not necessarily someone out of college who's like, I really want to be a financial advisor and I'm going to launch an RIA.
Well, I would agree with most of that statement. I think it's accurate. The very last part you just talked about was, it's interesting. There are now financial planning majors in major universities, Texas Tech and Virginia, and the list goes on. And so I think because the industry has moved away from a wirehouse throwing a phone book at you and saying, go to work, and you got 6 months worth of declining pay until you're on commission. It's moved away from that. And so younger people are saying, oh, this might be an industry I'm interested in, a profession I'm interested in. I can graduate, sit for the CFP immediately. And there are now registered investment advisory firms that are fiduciaries that work on a fee basis that will bring you on board with salary and bonus. We're one of them. So we have a residency program, much like the medical profession, where we'll hire young people right out of school. They sit for their CFP and we sign them up for a 3-year deal. And they're going to learn all about the firm. And by the end of year 2, they're sitting in client meetings with a senior advisor. And in year 3, they're conducting some of those meetings with a senior advisor, so that by the end of year 3, we'll know if we want to hire them to be a financial advisor at the firm. And we can hand them a book of 50 to 100 million based on senior advisors either retiring or just going up market and taking care of larger and larger clients and sending the smaller clients to these young CFPs. So it's working out really well.
So you hit on several things I wanted to touch on, and we'll get into them in the next couple of minutes, hopefully, before we got to wrap up. So one is, I won't say who, but I was on the phone earlier this morning with a very, very large RIA, also growing at a fast clip. And one of the things that this person said there was they're struggling the most with, when this person came on, she said, we had this really great, strong apprenticeship program, and we've kind of lost that. We don't necessarily have the good training, and we don't have a way of passing down what is best about behavioral finance, really deeply understanding clients. And you shared with me that you have been following Kahneman and Tversky since the early 90s. You kind of have embraced and embedded behavioral science in how you advise clients and training your advisors from very early days. Again, made the early bets before it became cool, it sounds like, and before everyone else kind of got there and went on that train. How are you looking at that and scaling it, training kind of younger advisors as part of that residency program and embracing the behavioral finance psychology part of connecting very deeply with clients?
Yeah. Well, first of all, it's I don't have to introduce them to behavioralism anymore because they're teaching it, right?
Yeah.
That's a wonderful thing. They come with some knowledge about it, at least textbook knowledge. What we're going to give them is, street knowledge. What we're going to give them is actual experience. So I'm surprised you heard that from someone. I don't think there's a secret sauce to this, but we put these young people in meetings with clients as early as possible. They're not saying a word. They're observing. And I think the best teacher is sitting with an advisor who's been doing this for 20 to 30 years and watching how they interact with the client, watching the questions they ask, watching how they exhibit empathy to the client. So you learn through osmosis, mostly. Secondly, we are always looking to add to our tech stack with providers that are building in a behavioral portion or a behavioral component to what they're offering, financial planning, data gathering, and even AI advice that is there for the financial advisor to decide yay or nay. It should have a component of behavioralism in it, and it does. They're just starting. It's very exciting. It's the early days of this. You know this with Nomi. So, and I haven't had to encourage financial advisors to do this. They volunteer it when we're going through the process of vetting them out and they're vetting us out. So before they join us, invariably, most of them will ask, I'm really interested in mentorship. And I'm like, do you really know what that means? I mean, not the definition of the word, but what it's going to take. You're going to have a young person shadowing you. They're going to be able to ask you questions. They're going to sit in on meetings. It's a wonderful experience to be a mentor. It's very fulfilling, but I want to make sure you understand what it entails. And they all say, yeah, they're educated and intelligent people. And what's more exciting is after 6 months, I'll say, how's it going? You have so-and-so in your office, a 20-something person who's interested in our profession. How's it going? And so far, they love it. They love having a young person asking them questions. They love having a young person who's learning from them how to interact. And interacting with an individual investor, I believe, is far more behavioralist than it is transactional, than it is data gathering. I think you're an educator. And when you embrace being an educator, like I used to do when I was talking to clients, I would tell them, I'm here to teach you how to be a successful investor. I know how to do it. I'm going to teach you how to do it. I'm going to teach you how to act, teach you the questions to ask, teach you how to behave when the market goes up, teach you how to behave when the market goes down. And that's all behavioralism. That's all anticipating the biases that are inherent in everybody's decision. And it's teaching them about their own emotional ties to money and how it affects their decision making.
I love that you said that they are learning it. They're learning kind of the technical side, the scientific side from a textbook. And we now know these things. A lot of advisors that got started in the 80s and 90s didn't have the benefit of, the textbooks that told them about, all of the biases that we have that keep making us make decisions that are bad for our future. There is a reason behind all of that. And the more we understand it, the more we can apply it. And so the caliber of these advisors that are coming in with sitting next to these researchers researchers who are studying how does that continue to evolve and seeing it proven out in fact, and then going in, as you said, like street learning. I think that it is so fantastic. So you call yourself, both here and in our prior discussion, you call yourself a teacher first, which is such a rare and beautiful, I think, description of wealth management. My question for you is, what's next for Pat Sweeny? Are you already teaching in kind of broader settings? How do you want to apply that into your next chapter?
That's a good question. I'm 63 years old. I'll be 64 in a couple of months, and I'm thinking about the next phase of my life as I hand more and more responsibility off to my executive team, who's been with me a long time. Some of them 20 years. I could leave the company tomorrow and it would be fine. It would continue to grow and they'd do a great job. So I don't have any worries about that. I do enjoy speaking with our young employees, whether they're advisors or whether they're in client services or tech or marketing, wherever they are. I really enjoy talking to them because I want them to understand the opportunity in front of them. They're in an industry that has, I think, recently gone through an inflection point and is now poised and is growing dramatically the right way. I want them to be excited about the prospects for being in this industry going forward. So that's a teaching moment, and I take every advantage of that. I will definitely slow down and spend more time with my family. You hear that a lot, but when you get to my age, it becomes important. I have 2 grandkids now, and it becomes really important to spend more time with family. I think it's a cliche, work-life balance. What does it mean? It means different things to different people. But for me, it means I don't want to die at my desk. I want to be out of the office and spending time with those close to me and old friends and colleagues. I invite all of my former employees over the last, 30 years, almost 30 years, 25 years, to a big summer picnic every year. And it's wonderful to see people who worked for me for a long time, who took their career paths in a different direction to come and see them. And I think everyone should keep those connections because they're wonderful to have, number one, but you never know when you're going to be able to do business again with somebody because you've kept in touch with them. My future is going to be spending less time in the office, more time when I am in the office with younger folks. And I'll continue to meet with prospective partners as my team asks me to do. But they can do it all on their own now, and that allows me to, hopefully do the things that my wife and my family and I have been planning on doing for a long time.
That's amazing. Fantastic. You're welcome to always go through Know Me. You can test. We do have a very great envisioning process. And thank you for the call out earlier. I think it's exactly what we're aiming for, is get really clear on what it is that an advisor needs to know in order to increase that caliber of service. And we always ask, what is an instance in your life or a conversation that you've had that has changed your personal relationship with money?
Yeah, it tends not to be for me a moment, but a period of time. And that period of time started in the late 80s through really the late 90s. And it was the decision to learn the history of finance and to listen to the academics, listen to someone who didn't have an axe, right? That's an old saying in the industry. Well, what's his axe? What's his reason for doing this or their reason for doing that? And for me, it was reading Bogle, reading A Random Walk by Malkiel, reading everything I can get my hands on by Gene Fama, Ken French, Merton Miller, and then Tversky and Kahneman, and getting this body of work that was never presented to me. I mean, think about this, Marla. You're on Wall Street, and I was a young man, but I'm trading at that point in time hundreds of millions of dollars in various securities, and I had never heard of the giants of financial economics. They're never brought up to you. If you're working at Merrill, if you're working at Dean Witter, if you're working at Payne Weber and all those old firms back then, Morgan Stanley, you didn't know who those people were. And now everything we do, everything is based on the work by those people. So there were no such thing as PhDs at an investment firm back in the 80s, except for Dr. Marty Zwei. I'm aging myself. Now every RIA in America has a PhD on staff, So to answer your question, when I started seriously looking into economics and specifically financial economics, how markets work and how they affect everyday people, it changed the way I thought about giving advice. And I can tell you that it resonated with my audience. Whenever I spoke to a retail investor, they would say, no one's ever told any of this to me before. And then I knew I was onto something.
So we asked earlier, how did you do it? How did you scale from $1 billion to $8 billion in just a couple of years? I think we got our clear answer. I think what I just heard kind of reflecting back is that you went out and sought the answer and you listened to the academics that have kind of proven and trusted, here's how to build the mousetrap. And, the mousetraps that exist aren't doing it very well. We're going to do it in a way that reflects back on what academia has proven to us time and again. Pat, I'm super grateful for the conversation. Thank you so much for sharing your journey from the trading floor to talking to institutional investors to saying, hey, something doesn't sit right, and to building a beautiful, very deeply intentional RIA, both organically and inorganically. You're maintaining the culture, you're maintaining the focus on what is proven to be true, coming out of the thought leaders of our era. And you continue to focus on education, planning, shared values. It is the powerful model that I think is navigating exactly what this podcast is about, the next era of wealth. Where can our listeners go to learn more about you and Apella? And if there's advisors who are like, hey, I would love to be part of Apella, where can they go to take you up on that?
Well, we're happy to talk to them if anything I've said resonates with them. ApellaWealth.com is our website. We have a YouTube channel as well. Contact us. We're headquartered in West Hartford, Connecticut. We're up to some 25 offices coast to coast and growing rapidly. So we may even, have an office near you. That's the best way to get a hold of us. And, we're happy to have a conversation to find out if we're a good fit for you.
And I can just attest, Pat, I reached out to you blindly. You were so kind and so down to earth. And you clearly care authentically about this business. And it is very core to who you are and what you're looking to deliver well into the future. For our listeners, Pat said something really powerful today about knowing who you're for. You kind of talk a lot about what the money is for you. If you're building a firm, a practice, a legacy, how clear are you on that? Let me know in the comments. Share, like, and Pat, thank you for being with us today here on the Knowing Me, Knowing You podcast.
Thank you for having me, Marla. It was a pleasure.
Thank you for joining us on the Knowing Me, Knowing You podcast. If you enjoyed this episode, share it with someone who needs to hear it. And don't forget to subscribe, rate, and review. Your support helps us bring more transformative conversations to you. Until next time, keep discovering, keep growing, and remember, you're in control of your own financial story. Follow us for more conversations on financial confidence, self-discovery, and the future of money.